Hi, morning all. Welcome back to Mankapai Aiman here. Right, so let's take a look at the S&P 500 first. Well, it slipped by 0.05% on Friday's session to close at 7354 points, extending its losing streak for the five consecutive trading session. Right, so we believe the sentiment shift is mainly due to the mixed situation after the one of the Fed president hawkishly warned that the AI creation could fuel the structural productivity and the force further rate hikes. So this makes the investors anxious and was also backed by the data of the consumer sentiment index, which also keep the investors cautious. So technical wise, right, the index is now rebounding from the 7,300 points level, and to me, this is very a crucial level to gauge whether the index to continue downwards or can rebound up higher, right? So if you look at the China A50 futures index, right? Well, it experienced an early gap down last Friday, sliding into the negative territory on the global risk-off wave and heavy profit taking across the mainland tech counters following the conclusion of the China International Supply Chain Expo, right? However, the index formed a bullish intraday candlestick as it rebound, driven by the late session push from the supportive fiscal data from the government showing an uptick in the central government infrastructure spending. From the chart here, right, the level of 50,000 points is now deemed as the key level where the consolidation zone to break out lower or to rebound up higher and may test the 60,000 points level. However, looking at the SME lines, the overall trend are still uh, upwards as the bulls are still supporting the whole uh, structure. Now, shifting focus to the WTI crude oil futures, well, it declined heavily on Friday, sliding around 2.26% to settle below the psychological threshold at 69 US dollar. uh, which also touched its lowest level since March, I would say. So this happened as the global oil tankers ramp up transit and also officially exited the strategic Strait of Hormuz, indicating a major recovery of these physical supply flows, which also effectively overpowered the projectile attack on the cargo vessel near Oman and continued with the political friction, right? Yeah, for now, we still keep our negative bias intact, targeting for the 60 US dollar uh, per barrel level, with the recent stop loss hold firm at the $93 level, right? And looking into our Malaysia market, our local market, the FBM KLCR rebounded by 0.24 percent on last Friday's session to close at 1667 points, pairing a portion of Thursday's um, uh, uh, heavy losses or the decline on Thursday, while the FKLI futures followed suit with 0.15% gains. So the minor turnaround, right, was driven by the last minute wave of the bargain hunting in the key financial heavyweight names like Maybank, Public, CIMB, and also Tenaga, right, which step in to lift the main index before the close, despite broader market indices remain mixed as of last Friday. And also, we believe that the sentiment now remains mixed. And if you look at the FKLI closely, we are still expecting for the bullish movement to take the driver's seat and targeting for the 1,007 points level if the bullish able to follow through, right? So as I mentioned earlier, the driver for the FK KLCI on last session was came entirely from the large cap institutional rotation into the heavyweight defensive stocks. You see the finance block uh, uh, provided a massive heavy lifting with key banking giants like Maybank, the RHB. So this also coupled with the strong green across the utility sectors and also the industrial names like Tenaga, Big as well, right? And for our Malaysia trading stocks for today, we have Maxis, and the stock is on its breakout formation higher at 3.45 cent level on a strong volume. So with that, we expect the momentum to keep bullish and the stock able to propel higher to test the next resistance at 3.65 cent, followed by 3.85 cent level. So if the stock to clear below this 3.25 cent support, this could reverse the course and trend lower below this 21-day moving average as well. And next we have ISF Group. So the stock is experiencing a breakout as well, right? At 53 cent level. So if the stock remains bullish, we expect the price to reach 57 cent level in the coming session with a high volume. Second resistance is at 61 cent level. So do keep an eye at the 49 cent level for any attempt of reversal. So today we have two breakout stocks, which is one Maxis and also another one is ISF Group. So do keep an eye on these two stocks and put this in your watch list and we monitor together. And lastly, for the FCPO, well, it snapped the 3-day losing streak on Friday session, staging a minor 0.24% rebound to settle at 4,568 ringgit. While the bias, the bias remains structurally bearish due to the collapsing global oil costs and also expanding gene production. I think this temporarily relief rally was fueled by the fresh cargo surveyor data showing a robust of 10%-ish surge in Malaysia export for the at least for the first until the 25th June. Right. So, however, for now, we still keep our negative trading bias unchanged, aiming for the 4,500 level and also 4,390 ringgit level, with stop loss remains firm at 4,700 level. So that's all from me, and I pass the floor to Laalitha. Thanks, everyone, and happy trading.
Hello, good morning, everyone. So, I will be presenting the global outlook for today. Okay. All right. So, yeah. So the first thing is we can see the cracks are emerging ahead of the US-Iran final agreement scheduled on 17 August. The MOU signed on the 18th June did not sufficiently address critical issues first, such as they didn't address Iran nuclear program. Second, the provision of economic aid. And the third one, the imposition of potential tolls on vessels transiting the Strait of Hormuz. More recently, we can see the US president has indicated that any deal incorporating service or shipping fees would be rejected, reinforcing prevailing geopolitical uncertainties. This causes a modest offset in the gradual normalization of the traffic of Hormuz, alongside Brent crude stabilizing at around $72 per barrel. So we can see that Brent continued to fall while equity rally is seeing some fatigue. And next, we can see that RHB in a sentiment index continued to show no material improvement, suggesting that investors' comfort remains limited despite some easing in the geopolitical risk premium. Attention has increasingly shifted to the sustainability of the AI-led equity rally, where persistent risk profit-taking has driven AI-related equities below the recent peaks. This reinforces our conviction for the prudence, particularly given signs of valuation of exuberance with the KOSPI and the Nasdaq AI and Robotics Index. Moving on to the global equity flows has to turn not materialize nicely, but where flows may return to the favored to favor fixed income as investors turn defensive into the new week. And next on the US FFR rate. So the US Fed fund rates expectation remains volatile with swap markets now pricing approximately 1.4%, 1.4 hikes by year end, down from the 1.6 earlier into the week. Our baseline view remains unchanged, whereby no policy adjustment is expected into this year. Model estimates indicate that US core PCE inflation could moderate around 3% by year end from 3.3%. Currently, assuming that an average Brent price of $85 per barrel into the second half of the year, thereby reducing the additional need for tightening. Looking ahead, the upcoming US ISM manufacturing, price components, and non-farm payrolls data will be the key focal points to be watched. Upside surprises in the inflation or signs of labor market weakening could also revive rate hike expectation. At the same time, forthcoming S&P PMI for the key ASEAN economies such as Indonesia, Malaysia, and Thailand may present upside risk, supported by the recent recovery in the export performance seen in the latest in the recent months. That's all for the global economic update. Thank you. Handing over to the next presenter.
Right, thanks, Laalitha. So we have a note out on Tenaga Nasional. We maintain buy is still a top pick for the energy sector. Our target price 1650 presents about 16% upside, and we still see a 4% yield. So this report essentially is a key takeaway from a site visit that we did to their renewable assets in Terengganu. We visited three key assets. The first one was a 100 megawatts or 400 megawatts hour battery storage in Santong. So essentially, this is a battery storage solution that Tenaga has built as a grid forming asset, meaning that it actually helps to generate voltage output and frequency that is connected to the grid. And this was actually built in less than 1 year. The capex of this project is about 380 million ringgit, and it forms parts of the Tenaga 42 billion regulated capex that was approved under RP4. Based on the 7.3% allowed returns, we estimate about 26 million contribution per annum from this project. But I think what's more important is that basically Tenaga has identified about potential up to 3 gigawatts of battery storage that they will need to install in order to support your 6 gigawatts of renewable energy that will be coming up on the grid. Hence, assuming about 3 gigawatts of battery storage, we do estimate a 14% upside to our FY28 earnings, given that this will be captured under the regulated capex for RP4. The second asset that we visited is the floating solar. Essentially, this floating solar will only be completed in 2028, but this is a first floating solar that they'll be building on about 10% of the surface water level at Kenyir Lake. And this is part of the crest where they are selling power to day one data centers for about 21 years. Based on the current grid price and also about 70% stake, we do estimate about 12% project IRR for this and about 3% earnings contribution to the group. Do note that the management is targeting about 2.5 gigawatts of floating solar capacity. And based on these kind of numbers, which will probably take another 5 years to build, this will contribute about 13% of our earnings. The third asset I visited is the Sultan Mahmud hydropower plant. This plant is located at Kenyir Lake as well, and they are essentially looking to extend the life of this hydropower plant beyond the 2030 sort of end of tenure for their current PPA. After which then the plant will have basically another 40-year lifespan. The EPCC contract, we estimate it could be valued about 3.5 billion. And we expected the tender to be awarded by year end. And do note that essentially, if you recall, recently they also have did an extension program for the Sungai Perak hydropower plant as well, of which they did award the EPC contract, I think, to a high-tech Padu. So we do think that again for this, we do expect the award to happen sometime by year end to a consortium. Given that the hydropower, given the lifespan of a hydropower plant is actually quite long. So all in, we still maintain our Tenaga as our topic for the sector, given that they're still the best catch-all for the whole energy transition roadmap in Malaysia, and also to capture the upside from data center plant-ups, given that they need energy for this sector. So all in, that's all for us for today. We wish you a good day of trading, and we'll see you again tomorrow for the next morning cuppa. Have a good day.